All right, welcome. Today we're going to tackle a really big question, one that's probably on the mind of anyone thinking about retirement. How in the world do you get market-style growth without taking on all that market risk? We're going to dive into a financial tool that was built to do just that, the equity indexed annuity. We'll look at what it was, what it's become today, and help you figure out if its modern version is a good fit for your financial plan. Let's jump right in. I mean, this is the classic retirement puzzle, isn't it? You know you need your money to grow. You can't just let it sit there. But at the same time, you're at a point where you really can't afford a huge loss from a market crash. You want that upside, but man, you are terrified of the downside. And it's this exact problem that led to the invention of a pretty unique solution. So the very first attempt to solve this puzzle came in the form of a product called the Equity Indexed Annuity, or EIA for short. And its promise was incredibly simple and, you can imagine, very appealing. Get a taste of the market's growth without ever risking your hard-earned principal. Now, the key thing to get here is that an EIA is a contract you make with an insurance company. This is not a direct investment in stocks or mutual funds. What the insurance company does is link your potential interest earnings to a market index, like the S&P 500. But, and this is the most important part, they also guarantee that your initial investment is 100% safe, even if that index takes a nosedive. Okay, I know what you're thinking. That sounds almost too good to be true, right? Market-linked gains with zero risk of loss? How does that even work? Well, it all comes down to a few key levers or mechanics that control how the interest gets calculated. Let's break those down. First up, and this is the big one, is the floor. Just think of this as your ultimate safety net. The most common floor, by far, is 0%. And what that means is, if the market index that your annuity is tracking has a terrible year, let's say it goes down 10, 20, heck even 40%, the interest credited to your account is simply zero. You don't make any money that year, but crucially, you don't lose a single penny of your principal. Now, as they say, there's no such thing as a free lunch. The trade-off for having that 0% floor, that absolute protection, is a ceiling on your potential gains, and we call that the cap rate. So, for example, if the index has a fantastic year and shoots up 10%, but your contract has a 6% cap, then your account gets credited with 6%. You're basically trading away that unlimited upside potential in exchange for completely eliminating any downside risk. So, besides a cap, there's another way these things can work, and it's called a participation rate. Instead of a hard ceiling, this just determines what percentage of the index's gain you actually get to participate in. So let's say the index goes up 10% and your participation rate is 80%. Well, you do the math. Your account gets credited with an 8% gain. It's just another tool the insurance company uses to manage their risk while still giving you a piece of the action. And on top of all that, there are even different ways the interest can be calculated over time. Some contracts, for example, lock in your gains every single year, which is a really popular feature called an annual reset. Others might measure the performance over a longer period. The main takeaway here is that there's a lot of flexibility built in, which lets these products be tailored to different kinds of financial goals. All right, so now that you get the basic mechanics of how these original equity indexed annuities worked, I have to let you in on a little secret. The product we've just spent the last few minutes describing, well, it doesn't really exist anymore, at least not in that original form. That's right. The term equity indexed annuity is pretty much outdated. You see, since these were first introduced back in the 90s, they've gone through a major evolution. It was really driven by people like you, demanding more choices, more transparency, and just overall better features and protections. And this slide really lays out that evolution perfectly. On the left, you've got the original EIA, which was pretty basic. But today's version is called a fixed index annuity, or FIA. And you can see they offer so much more, like uncapped strategies that can have better long-term potential, a much wider selection of indices you can choose from, and honestly, just clearer and more transparent contract terms. It's really a next-generation product. This brings up a super common question. People ask, if it's linked to an equity index, why on earth is it called a fixed annuity? And the reason is absolutely critical to understand. Your money, your premium, is never, ever directly invested in the stock market. The insurance company keeps your money safe in their general account, and they are the ones who assume all of the market risk. Your principal is fixed and guaranteed by them, period. So we've covered what a fixed index annuity is and how it evolved from the old EIA. But now for the million-dollar question, right? Is this product actually a good fit for you and your retirement goals? Let's lay it all out on the table, the good and the trade-offs. The pros are really powerful. You get 100% principal protection. Your growth is tax deferred, which is a huge advantage. You have the potential to earn way more than you would in a CD or a traditional fixed annuity. And you can add features that guarantee you an income stream for the rest of your life. On the flip side, your upside is limited. And a big one is the surrender charges. This is not short-term money. If you need to pull your cash out early, there are penalties. So, who is this really built for? It's for people who are getting close to retirement or are already in it, and their mindset has shifted from grow my money at all costs to I need to protect what I've built. If market volatility makes you nervous, and if the idea of creating your own personal pension, a reliable income stream, sounds good to you, then an FIA is definitely worth looking into.
Now let's be really clear about who this is not for. If you're a young investor and you've got decades to ride out the market's ups and downs, you're probably better off with direct market exposure. And because of those surrender charges we mentioned, this is absolutely not the place to park your emergency fund or any money you think you might need in the next 5 to 10 years.
Okay, so let's say after hearing all that, you're thinking, you know what? This actually might fit my needs. The next challenge is that there are hundreds of these products out there. How on earth do you choose the right one? Well, let's walk through a simple but really effective framework. This quote right here, this is the absolute golden rule. It is so easy to get distracted by a flashy brochure with a high cap rate or some amazing hypothetical return. But if your number one goal is to create a reliable paycheck in retirement, then the first and most important thing you should compare is the guaranteed lifetime income payout. Everything else is secondary. So, to make this super simple, just follow this process. Step 1. Start with your income goal. Compare what different contracts guarantee to pay you for life. Step 2. Look at all the other guarantees. What are the surrender charges? What's the death benefit? And how financially strong is the insurance company backing it? And finally, step 3, get some expert help to compare these contracts side by side. Make sure you're not missing any of the important fine print.
Look, we know navigating these products can feel complex, and working with a specialist who can lay out different options for you is really a wise move. We hope this has given you a much clearer picture of fixed index annuities, and if you'd like to see what the solutions might look like for your specific situation, our team here at The Annuity Expert is ready to help. We provide free quotes and comparisons with expert advice. Just give us a call at the number on your screen or visit us online. Thanks for watching.